There's a quiet shift that happens in every trader's journey. At some point, you stop asking, "What should I buy?" and you start asking, "Who is buying?" And that is the moment everything begins to change, because that's when you move away from a retail mindset and start thinking like institutions. Let's start with a simple truth. Markets are not moved by opinions, they are not moved by news headlines, and they are definitely not moved by indicators alone. Markets move because of capital, large capital, mutual funds, hedge funds, pension funds. These are the players who create real trends. Think about a stock like Apple Inc. Do you really believe it moves 3 to 5% because retail traders decided to buy it? No. It moves because billions of dollars are being deployed over days, weeks, and months. So the game is not to predict the market. The game is not to guess tops and bottoms. The real game is this: to learn how to read the footprints of institutional money. Because while we cannot see their orders directly, we can absolutely see their impact. Retail traders are obsessed with one thing: buying at the lowest possible price, catching the bottom. There's pride in saying, "I bought it at the exact low." But here's the reality: that rarely leads to consistent profits. Institutions don't buy like that. They don't wait for the perfect bottom. Because they cannot. Their size is too large. They need time to build positions. Look at how stocks behave before big moves. They don't explode immediately. They go sideways. They become boring. Low volatility, low excitement. This is what we call accumulation. This is where the real story begins. When a stock stops falling and starts moving in a tight range, something important is happening. Sellers are getting exhausted. Supply is being absorbed. Think about how many times you've seen a stock stop going down, move sideways for weeks, and then suddenly break out that sideways phase. That's not random. That's patient money at work. Your job is not to jump in early. Your job is to recognize when quiet accumulation turns into visible demand. If there is one thing you should respect in the market, it is volume. Because price can lie, but volume rarely does. When a stock breaks out and volume expands significantly, 2 times, 3 times its average, that is not retail participation. That is institutional commitment. Let's say a stock has been trading quietly for weeks. Suddenly it breaks out, and volume spikes massively. That is not coincidence. That is demand, real demand. That is your invitation, not before, not during guesswork, but when demand becomes undeniable. Now comes one of the hardest mindset shifts. Learning to buy strength. It feels uncomfortable because the stock has already moved. It feels like you've missed it. But strong stocks are strong for a reason. They're being supported. Look at stocks during strong bull phases. They don't stay cheap. They keep making new highs because institutions keep buying. Compare a stock to the broader market. If the market falls and the stock holds strong, that's strength. If the market rises and the stock rises faster, that's leadership. Now comes the real challenge: not entering the trade, but staying in it. You buy. The stock goes up, then it pulls back slightly, and you panic. You exit early, take a small profit, and watch it go higher without you. Institutions don't react like that. They expect pullbacks. They understand trends have rhythm. Strong moves leads to high volume pullbacks, leads to low volume. If the pullback is slow, it's not weakness, it's digestion. This is where most traders fail. They take profits too quickly because it feels safe. But small wins don't build wealth. Instead of asking, how much profit do I have? Ask, is my reason still valid? Some traders increase position size only when the trade works, not averaging down, but adding to strength. Just like institutions leave footprints when they enter, they leave clues when they exit. High volume but no price progress. Failed breakouts, increasing volatility, break below key support on heavy volume. That's not normal. That's pressure. When a stock goes vertical, everyone is talking about it. That's often the end, not the beginning. In the end, this approach is not complicated. It comes down to three things: price, volume, relative strength. You're not trying to outsmart the market. You're trying to align with the people who already move it. And when you start thinking this way, something changes. You stop chasing noise. You stop forcing trades. You become patient. You wait. You observe. And you act only when the evidence is clear. Because the market was never random. You were just looking in the wrong place.